There's a tax change that quietly went live on the 1st of this month, and depending on when you order your next vehicle, it could add hundreds of pounds to a cost thousands of families have relied on staying exactly the same for years. Let's break down exactly what changed, who it actually affects, and what the real numbers look like once you strip away the panic headlines. We're talking about the Motability scheme, the arrangement that lets people receiving certain disability benefits exchange part of that support for a leased vehicle. And from the 1st of July this year, 2 specific tax changes now apply to most new leases taken out under the scheme. The first is standard rate VAT, 20%, now applying to what's called your advance payment, the optional upfront top-up you pay if the car you want costs more than your basic mobility allowance covers. The second is insurance premium tax, now applying at the standard rate to the insurance built into most new Motability leases. Insurance that previously benefited from tax relief, keeping the overall cost of the scheme lower than a typical private lease. Here's the number that's actually been causing most of the anxiety around this change, and it's worth being precise about it rather than repeating the vaguer, scarier versions circulating online. Motability Operations itself estimates the average advance payment across the scheme will rise by around £400 over the course of a typical 3-year lease. That's an average, not a fixed universal surcharge applied identically to every single customer. And it matters because the actual impact depends enormously on which specific car you're choosing. A car with a nil advance payment, meaning it sits entirely within your basic mobility allowance with nothing extra to pay up front, is unaffected by this change in any meaningful way because there's no top-up for the new VAT to apply to in the first place. A car with an existing advance payment of £1,500 would see 20% VAT added to that specific top-up amount, taking it to £1,800, a genuine increase, but a considerably smaller one than a flat 20% applied to the entire cost of the vehicle would suggest. It's worth being completely clear about who this actually touches, because a lot of confusion has spread specifically around existing customers assuming their current arrangement is at risk. If your lease agreement began before the 1st of July this year, absolutely nothing changes for you. Your advance payment, your insurance terms, your monthly cost, all of it continues exactly as originally agreed until your existing lease naturally comes to an end. There's no retrospective charge landing on current customers, no top-up demand arriving through the post, and genuinely nothing you need to do if you're already partway through an agreement. The new taxes apply specifically to leases entered into from the 1st of July onwards, which means the moment that actually matters for you is when you collect a new vehicle, not when the change itself came into force. That collection date detail is worth understanding properly, because it's slightly different from how people often assume tax changes apply. Your lease agreement is treated as starting the day you actually collect your car, not the day you originally placed your order or signed initial paperwork. So if you ordered before the change took effect, but your actual collection date falls after the 1st of July, the new tax treatment does apply to your lease, while your advance payment amount itself remains protected under the scheme's price freeze, meaning the headline figure you agreed to at application doesn't move even as the tax sitting on top of certain elements does. Wheelchair-accessible vehicles occupy a genuinely different position throughout all of this, and it's worth flagging clearly because a lot of general coverage has lumped WAV customers in with the wider changes without proper distinction. For a lease to continue benefiting from VAT relief, HMRC's criteria specifically require that the customer normally uses a wheelchair or is carried on a stretcher, and that the vehicle itself is adapted to allow that customer to travel in it. Where those criteria are genuinely met, WAVs remain exempt from both the new VAT and the new insurance premium tax, continuing under broadly the same protected terms as before. If you're ordering a vehicle that meets this criteria, you'll be asked to complete a customer eligibility declaration confirming your circumstances, and it's worth double-checking your specific adaptation genuinely qualifies before assuming the exemption automatically applies, rather than discovering otherwise after you've already ordered. There's also a broader piece of context worth understanding about why this happened in the first place, because it wasn't a decision Motability Operations itself chose to make. The UK government announced these tax changes as part of the autumn budget back in November last year, removing the specific VAT and insurance premium tax exemptions the scheme had benefited from for years. Motability Operations has been publicly clear that this increases the overall cost of running the scheme, and that it's actively reviewing other areas of the leasing package, mileage allowances, overseas breakdown cover, and increased use of telematics for insurance purposes among them, specifically to try to absorb as much of that additional cost centrally as possible, rather than passing the full amount directly on to individual customers. If you're in Scotland, this entire set of changes doesn't currently apply to you at all, which is worth knowing if you've seen general UK coverage without regional detail. The Motability scheme in Scotland operates under a separate arrangement called the Accessible Vehicles and Equipment Scheme, and Motability Operations has confirmed it's working directly with the Scottish Government to understand how or whether similar changes might eventually apply there. For now, if you're ordering through the Scottish scheme specifically, the 1st of July changes affecting the rest of the UK simply don't touch your lease. Alongside these tax changes, there's a separate but related shift worth knowing about if you're specifically choosing between manufacturers. Certain premium brands, including names like BMW and Mercedes-Benz, have been removed from the Motability scheme entirely as part of a wider refocus toward what the organization describes as practical, affordable mobility options. This isn't a tax change in itself, but it does mean if you'd previously had your eye on a specific higher-end model through the scheme, it's worth checking whether that manufacturer remains available before you get too far into planning around a car that may no longer be on the approved list. It's worth walking through a concrete example to make all of this genuinely tangible, rather than leaving it as abstract percentages. Say you're choosing a car with a £2,000 advance payment, a fairly typical mid-range top-up for someone wanting a slightly higher specification than their basic allowance alone would cover. Under the old rules, that £2,000 was the full figure, no VAT sitting on top of it. Under the new rules from the 1st of July, 20% VAT applies specifically to that advance payment element, adding £400 and taking the total to £2,400. That's a real increase, and it's not something to wave away, but it's also considerably more specific and more manageable than the vague, "prices are rising sharply," framing a lot of general coverage has used. If your chosen car instead sits entirely within your basic allowance with a nil advance payment, none of that calculation applies to you at all, because there's simply no top-up figure for the VAT to attach to. The insurance side works slightly differently and is worth understanding on its own terms. Every Motability lease includes comprehensive insurance as standard, covering up to 3 named drivers, and until the 1st of July this year, that insurance element benefited from tax relief that a typical private insurance policy doesn't receive. From the 1st of July, insurance premium tax now applies to that built-in cover at the standard rate, the same rate any other UK driver effectively pays through their own private insurance premium. Motability Operations has been clear this will lead to what it describes as a modest increase in overall leasing costs, rather than a dramatic one, precisely because insurance is only one component of the total package, sitting alongside the vehicle cost, maintenance, breakdown cover, and tire replacement that remain bundled into the same monthly figure throughout your lease. It's also worth understanding what Motability Operations has said about protecting affordability going forward, because this isn't simply a case of the organization passing every additional cost straight through to customers without any mitigation. The organization has explicitly stated it's examining a range of other areas within the leasing package, specifically to help absorb these new costs, including mileage allowances, the scope of overseas breakdown cover included as standard, and increased use of telematics data for insurance pricing purposes, which can in some cases help identify lower-risk drivers and offer more favorable terms in return. Importantly, any changes arising from that wider review are described as still being assessed for their impact on disabled people specifically before being confirmed, rather than being rolled out immediately alongside the tax changes themselves. If you're currently going through the application or ordering process, it's worth checking Motability's own updates page directly for the latest confirmed position on any of these secondary changes, since that page is being actively kept current as decisions are finalized. So let's bring this together into something you can actually use if you're navigating this scheme right now. If your current lease started before the 1st of July, you're completely unaffected, nothing to check, nothing to do. If you're ordering a new vehicle going forward, the actual cost impact depends heavily on whether your chosen car requires an advance payment at all, with nil advance payment vehicles remaining the most straightforwardly affordable route through the scheme. If a top-up is required, expect roughly a £400 increase on average across a typical 3-year lease, though your specific figure will depend on the exact size of your advance payment. If you or the person you're supporting genuinely meets the wheelchair-accessible vehicle criteria, confirm that eligibility properly through the customer eligibility declaration, because that route remains meaningfully protected from these changes. And if you're specifically interested in a brand that's recently been removed from the scheme, check its current availability before building plans around it. It's worth ending on a practical note for anyone actively comparing quotes right now, because the price freeze mechanism genuinely matters here and is easy to overlook. Motability's price freeze means the advance payment figure quoted to you at the point you apply is locked in, regardless of any pricing adjustments the scheme makes afterward. That protection remains in place. It's simply the new tax sitting on top of that locked figure that's changed from the 1st of July. If you're partway through comparing vehicles and haven't yet applied, getting a clear written figure for your specific advance payment and understanding exactly how the new VAT applies to that number is worth doing before you commit, rather than working from a general percentage figure that may not reflect your actual chosen vehicle. None of this is designed to suggest the Motability scheme has become unaffordable or unreliable overnight. The core structure, an all-inclusive lease covering insurance for up to 3 named drivers, maintenance and breakdown cover, remains fully intact, and Motability Operations has been explicit about actively working to absorb as much of this new cost as possible, rather than passing the entire burden onto customers directly. But the headline figures circulating in less careful coverage have genuinely overstated the average impact for a lot of customers, particularly those whose chosen vehicle sits within their basic allowance, with no advance payment at all. It's worth remembering why this scheme carries the weight it does for the people who rely on it, because that context is easy to lose inside a conversation focused purely on tax percentages and pricing tiers. For many disabled people across the country, a Motability vehicle isn't a discretionary purchase. It's the thing that makes independent travel to work, medical appointments, and family visits genuinely possible in the first place. That's precisely why Motability Operations has framed its response to these tax changes the way it has, treating the review of mileage allowances, breakdown cover, and telematics not as cost-cutting for its own sake, but as a deliberate attempt to protect exactly that independence for as many customers as possible, while absorbing a cost increase that wasn't the organization's own decision to introduce in the first place. If this helped you understand exactly what's changed, who it actually affects, and what the real numbers look like for your specific situation, hit subscribe, because I'll keep covering how this scheme evolves as Motability Operations works through its wider review of the leasing package. Stay safe out there, and I'll see you in the next one.